Hi everybody, imagine a company whose sales are booming, profits look healthy, the CEO is giving interviews, and yet one day it runs out of cash and collapses. It happens not because the product was bad, not because the demand vanished, but because of one silent killer, which is working capital. Most people think that businesses die because of sales drop. But businesses can actually die when sales grow too fast and working capital can't keep up. The more sales leads to more inventory and more receivables, which in turn leads to more cash stuck in working capital. A true businessman knows that growth without cash flow is a silent killer. Several major Indian companies have collapsed or faced severe depression due to their inability to manage their working capital requirements. Kingfisher is the most prominent example of a company that collapsed due to lack of liquidity. Jet Airways collapsed due to lack of liquidity, and the list is long. In this video, we will look at what is working capital, how we can track it, and what is its significance for an investor. Let's start the video. Working capital in simple terms is a money that a business needs to run its day-to-day operations smoothly. Think of it as fuel in tank that keeps the business moving between paying the bills and receiving the payments. Say for example you run a small trading business. The amount of cash that you need to buy the stock initially, pay the salaries, pay the rent before you receive your payment is working capital. In financial statements, working capital can be found out in three places. First is receivables, which says about the money that your customers owe you. Second is inventory, which tells us about the amount of goods of stock lying unsold. And third is payables, which says about the money that you owe to your suppliers. Now, working capital plays a very significant role in any business. We will talk about top three. First, it decides whether a business can run its day-to-day operations. Many businesses fail not because of profit failures, but because they can't pay their bills on time. Second, when more money is stuck in inventories and receivables, there is usually a higher borrowings, which in turn increases the interest cost and thus impacting profitability. And third, working capital is a strong indicator of business quality. When customers pay fast, inventories turn quicker, and the supplier gives comfortable credit, it is the indicator that a business is a very strong quality. So, here is a key lesson for an investor that we can derive from the above study. Investors need to look at a metric called cash conversion cycle, which is equal to inventory days plus receivable days minus payable days. Cash conversion cycle signals the quality of business. Business quality is very good when cash conversion cycle is maintained as sales increases. Otherwise, business quality is bad. Thus, higher cash conversion cycle means lower cash conversion, and so investors give lower PE ratio to such businesses. So, for an investor, for every business you analyze, you must ask, do profits turn into operating cash over a full cycle? For this, you need to track cash flow from operations versus profit after tax over 3 to 5 years. If profits grow but cash doesn't, treat it as a red flag. Another way to look at it is to track cash conversion cycle over 3 to 5 years. Observe that when sales grow, is cash conversion cycle increasing or decreasing? Increasing cash conversion cycle during growth may turn out to be a trap. And finally, to end this video, remember, if you understand working capital trap, you won't just become better investor, you will become a better business person. And that was it for today's video, and I hope this video was valuable to you. If this video provided some value, please like this video and subscribe to this channel for more such investment case studies. Thank you so much for watching. I will see you in the next video.